Today, we are diving headfirst into a company that is, without a doubt, at the very center of the tech universe right now, Nvidia. The big question on everyone's mind, is this a once-in-a-generation tech titan, or is it a stock that's just dangerously overvalued? Well, we're going to get to the bottom of that. We're going to tear through the hype, dig deep into their latest financial filings, and break down a detailed third-party analysis. So buckle up, because this is the complete, unabridged guide to understanding the financial engine of the AI revolution.
All right, so here's how we're going to tackle this. First, we'll get the big picture with an executive summary and the top risks you need to know about. Then, we'll dive into the numbers behind their incredible growth and profitability. After that, we'll check the foundations, their cash flow and balance sheet. We'll also look at the people in charge and their strategy. Then comes the main event. We'll put Nvidia head-to-head with its competitors to talk valuation. And finally, we'll pull it all together for the conclusion. Let's do it.
Okay, first up, the executive summary and top risks. We're starting with the 30,000-foot view here, the core investment thesis, and the key tensions that every investor needs to understand. This really sets the stage for everything else we're going to talk about.
So what's the central conflict with Nvidia? It's actually pretty simple. You've got a company that is just crushing it on every level. Unbelievable growth, total dominance in its field, but, and this is a huge but, you have to pay an astronomical price to own a piece of it. This constant tug-of-war between world-class performance and a sky-high valuation is the theme we're going to see again and again today.
And you can hear the excitement straight from the top. CEO Jensen Huang talks about this virtuous cycle of AI, and it's basically the rocket fuel for the whole bull argument. Think about it. Smarter AI needs more powerful chips. Nvidia makes those chips. Those better chips then create even smarter AI, which in turn demands, you guessed it, even more powerful chips. It's this incredible feedback loop that has investors thinking this growth could go on for years.
So that's the story of insane demand. It sounds almost too good to be true, right? And that's our job today, to look a little deeper. So what's the catch? What are the pressures hiding just beneath the surface of these amazing numbers? This is where we pivot from all the good news to the critical risks that create that tension we're talking about.
The analysis we're looking at boils it all down to three major red flags. First, their customer base is tiny, dangerously tiny. Second, they've already shown they can get hit with massive financial charges from things outside their control. And third, the valuation is so steep it leaves basically zero room for error. So let's unpack each one of these.
First, let's talk about revenue concentration. What does that even mean? Well, just think of the old saying, don't put all your eggs in one basket. It's the same idea for a giant company. If way too much of your business comes from just one or two clients, and one of them decides to walk away, you're in some serious trouble.
And this isn't just some theory, this is the reality. These numbers are pulled directly from Nvidia's own financial statements. Take a look. This shows who owes them money. And wow, that is a short list. Just 4 companies make up nearly 2/3 of all their receivables. To put it simply, if those 4 clients have a bad quarter, Nvidia has a bad quarter, period.
So what does this actually mean? Well, these customers are the giants of tech, the hyperscalers like Amazon, Google, Microsoft, Meta. They're buying Nvidia's chips by the truckload. And while that's fantastic for business right now, it creates this enormous dependency. What happens if one of them decides to build their own chip, or even just decides to slow down spending for a few months? The impact on Nvidia's top line would be massive and immediate.
Okay, on to red flag number 2, regulatory risk. And to show you just how real and painful this risk can be, I'm just going to put a number up here. $4.5 billion. That's not profit, it's not revenue. That was the size of a single charge the company had to take because of a regulatory issue. So where did that staggering $4.5 billion charge come from? Geopolitics. Plain and simple. When the US government put restrictions on selling high-end chips to China, Nvidia was suddenly stuck with a huge pile of inventory it couldn't sell. So this isn't some abstract risk you read about in the newspaper. This is a real-world, multi-billion-dollar hit to the company's financials, caused by a decision made hundreds of miles away in Washington, D.C.
And that brings us to the final red flag, the price tag. The price to earnings, or PE ratio, basically tells you how much you're paying for $1 of a company's profit. For most companies in this sector, you might pay somewhere between 20 and 30 bucks. For Nvidia, you're paying around 45. This means the market isn't just expecting them to grow, it's expecting them to grow perfectly for a very long time. If there's even a tiny stumble, a valuation that high can fall and fall hard.
Okay, so we've laid out the risks. Now let's talk about why everyone is so excited in the first place, and why people are willing to pay that high price. It's time to head into the engine room and look at Nvidia's absolutely explosive growth and its truly world-class profitability. This is the core of the bull case.
You can pretty much sum up Nvidia's growth engine in 2 words: data center. I mean, just look at this breakdown. It's not just the biggest piece of the pie, it's basically the whole pie. At nearly 90% of all revenue, it makes everything else look like a hobby. When you invest in Nvidia today, you are making a massive, concentrated bet on the future of AI-powered data centers.
And the growth in that data center business is, well, it's just mind-boggling. This chart shows the year-over-year growth. The company's total revenue is up 62%. For a company this big, that is just incredible. But look at what's driving it. Data center revenue is up 66%. Even their more mature gaming business grew a healthy 30%. This isn't just growth, this is hyper-growth at a scale we've rarely seen before.
Now, growing fast is one thing, but making a ton of money while you do it is another. For that, we look at a metric called EBITDA margin. Before I show you the number, let's just quickly define it. EBITDA basically strips out all the noise from accounting choices, taxes, and financing decisions. It gives you a really pure look at how profitable the actual core business is.
So what is Nvidia's EBITDA margin? It's around 60%. Let me say that again, 60%. For a company that designs and sells physical hardware, that number is absolutely insane. Those are the kind of margins you see from a high-end software business. It tells you 2 things very clearly. They have immense pricing power, and they run an incredibly efficient operation. And this incredible profitability story holds up no matter how you slice it. Their gross margin is over 73%, which means it costs them very little to actually produce their products. After you factor in all their operating costs like R&D, their operating margin is still a massive 63%. And when all is said and done, their final bottom line net margin means that almost 56 cents of every dollar in sales becomes pure profit. It's just phenomenal. Okay, so we've seen the incredible growth and the eye-popping profits. But does that all translate into actual, cold, hard cash? And just how strong is the company's financial foundation? It's time to move on and really examine Nvidia's cash flow and the strength of its balance sheet. You know the old saying in finance? Profit is an opinion, cash is a fact. That's why we always compare the net income a company reports to the actual cash it brings in. And with Nvidia, you can see a bit of a gap. They've reported more profit than they've collected in cash. Now, this isn't necessarily a bad sign. It's mostly happening because they're growing so fast, they're just waiting for some of those big customers to pay their bills. It's what you'd call a high-class problem, but it's something to keep an eye on. But an even better metric is free cash flow, or FCF. This is the real deal. It's the cash that's left over after a company pays for all its day-to-day operations and invests in its future growth. The FCF margin tells you what percentage of every single dollar of revenue turns into pure, usable cash. This is the money they can use to expand or reward shareholders. It's one of the best indicators of true financial health. And Nvidia's free cash flow margin is just off the charts, sitting at nearly 42%. Think about what that means. For every dollar of product they sell, they generate almost 42 cents in pure, flexible cash that they can do whatever they want with. This company is an absolute cash-generating machine. That kind of financial firepower lets you build an empire.
And that cash machine has built a fortress of a balance sheet. They're sitting on a mountain of cash. They have very little debt. Their debt-to-equity ratio is one of the best in the whole sector. But what's really interesting here are the off-balance sheet commitments. They have already locked in contracts to spend over $76 billion on future supplies and services. That tells you they are playing chess while everyone else is playing checkers. They're planning for years down the road.
Okay, we've gone deep on the numbers, but what about the people and the strategy driving those numbers? In this section, let's do a little diligence on the leadership team, their governance, and where they're placing their strategic bets. At the helm, you've got founder and CEO Jensen Huang. For many investors, this is a huge positive. Founder-led companies often have that skin in the game that you don't always get with a hired CEO. They're building a legacy, not just trying to hit quarterly targets. And a clean governance record in the analysis shows a leadership team that inspires a lot of confidence. You know, actions really do speak louder than words, and Nvidia's management is practically shouting their confidence from the rooftops. In the first 9 months of the fiscal year, they spent nearly $37 billion buying back their own stock. That is a powerful signal to the market.
They're effectively saying, we believe our own company is the best investment we can make right now.
And beyond investing in themselves, they're also making really smart, strategic investments in other companies. This table from their public filings shows some of their biggest bets. Look at that multi-billion-dollar stake in CoreWeave, a major AI cloud company. These aren't just financial plays. These are strategic moves designed to strengthen the entire AI ecosystem that depends on NVIDIA's technology. It's a brilliant way to widen their competitive moat.
And that brings us to what might be the most important question of all, where the bull and bear cases really have their showdown. We've seen the incredible business performance, but now we have to ask, is the price right? Let's get into it by comparing Nvidia to its competitors and applying some classic valuation tools.
Honestly, this one slide tells the entire story. In terms of performance, growth, margins, cash flow, Nvidia is a Formula One car racing against a field of minivans. It's not even a fair fight. But when you look at the price you have to pay, the valuation multiples like PE or EV/EF/EBITDA, you see that you're paying a massive premium for that performance. The whole debate boils down to whether that premium is justified.
That huge premium brings us to one of the most important concepts in investing, the margin of safety. The idea is really simple. You figure out what you think a company is truly worth, and then you only buy it if the stock price is way below that number. That gap between value and price is your margin of safety. It's your cushion, your buffer zone, in case you're wrong or something unexpected happens. So let's do a really quick classic value check. Right now, you can buy a 10-year U.S. Treasury bond, about as risk-free as an investment gets, and earn around 4.5%. If we take NVIDIA's PE ratio and flip it upside down, we get what's called an earnings yield, which is about 2.2%. So think about that. You're being asked to take on all the risks of an individual stock for roughly half the return of a super safe government bond. From a traditional value perspective, that's a really tough sell.
But maybe we're looking for a margin of safety in the wrong place. Maybe it's not in the price, but in the business itself. And for that, there's a really powerful metric called the self-sustainable growth rate, or SSGR. This calculates the absolute maximum speed a company can grow using only its own money, without having to borrow or sell more shares.
Now, the formula for SSGR looks pretty intimidating, I get it, but the concept behind it is what's important. It's measuring a company's internal horsepower. It combines how efficiently it uses its assets, how much profit it makes, and how much of that profit it plows back into the business. The result is one number that tells you how fast the company can grow all by itself.
And the SSGR result for NVIDIA is, well, it's over 1,000%. Yeah, I know that number sounds completely broken, and to be fair, it's a bit inflated by NVIDIA's business model where they don't own their own factories. But even if you take that with a huge grain of salt, the message is crystal clear. This company's ability to fund its own astronomical growth is practically unlimited. They are a self-fueling rocket.
All right, we have covered a ton of ground here. We've talked risks, growth, cash, management, and that crazy valuation. So let's bring it all home in our final section, where we'll sum up the business model and deliver the final verdict.
At the end of the day, NVIDIA's strength isn't just that they sell chips. It's that they have built the entire platform for the AI industry. Their competitive moat is incredibly deep. You have the proprietary hardware, the GPUs. You have the software, CUDA, that millions of developers are trained on and locked into. And you have the massive ecosystem of partners. This isn't just a competitive advantage. For now, it's a stranglehold.
So if we boil this entire deep dive down, this is what you're left with. The strengths are undeniable. They're number one in their field, they have the best margins in the business, their balance sheet is a fortress, and they can fund their own growth indefinitely. But the risks are just as stark. They are heavily reliant on just a few customers, they are exposed to unpredictable geopolitical risk, and the current stock price seems to have priced in perfection, leaving no margin of safety.
And so that leaves us with the one multi-trillion-dollar question that everyone is trying to answer. Is NVIDIA's premium price simply the fair cost of admission to own a piece of the future? Or is it a sign of a market that has fallen so in love with the story that it's willing to ignore some very fundamental risks? The answer to that question is going to shape the market for years to come, and it's a question that every single investor has to wrestle with for themselves.
You enjoy our deep dive into companies' quarterlings and fundamental analysis, please like and subscribe to our YouTube channel for more insightful content.